With Fed raising rates by 25 basis points, the focus is now shifted to the April MPC meeting. We think it will be a close call to raise the repo rate to 6.75%. Headline inflation is likely to trend lower in coming months. This should comfort policymakers and allow them to focus on growth, which seems to be losing some steam. We believe that global rate hiking cycle is probably coming to an end in the second quarter of 2023. We think MPC will hold policy rates steady in 2023 before cutting in 2024. This should cause Indian sovereign yield curve to turn steeper with short-term yields easing while long-term yields remaining sticky. Based on this, we believe it's time to start increasing allocation to fixed income assets in a gradual manner with focus on 5 to 10 year part of the yield curve. India's macroeconomic landscape is improving steadily. While inflation was higher in Jan and Feb due to higher pulses and core inflation remaining sticky at around 6% for last 12 months, inflation is expected to fall in FY24 and average at around 5.5% as compared to average inflation of about 6.7% in FY23. India's current account deficit is also going to be lower at around 2.4% of GDP in FY23 and likely to be lower at 2% in FY24, mainly due to smart recovery in services exports and lower crude imports. This bodes well for the economy and rupee-dollar exchange rate. India's GDP growth for FY24 is also expected to be around 6% to 6.5%. All this should give policymakers some comfort and allow them to keep policy rates unchanged in 2023. US rate hiking cycle is also expected to end in the second quarter of 2023, and this should ease pressure on EM sovereign yields and allow value buying to emerge. After raising repo rate by 25 basis points to 6.5% in Feb MPC and watching headline inflation being higher than their fourth quarter forecast in Jan and Feb, we still think April MPC meeting will be a close call as doubts within the MPC will likely point out the upcoming softening of headline inflation down the road and recent sharp fall in global bond yields. Crude prices have also remained soft and current account deficit is going to be lower in FY23 due to robust services exports. On the other hand, hawks within the MPC may point towards sticky core inflation and need to remain vigilant. On balance, we expect MPC to keep repo rate unchanged after their April MPC outcome. We expect sovereign yield curve to turn steeper in 2023 in a gradual manner. We expect short end of the yield curve to drift lower as market participants unwind further rate hikes in 2023, whereas the long end of the yield curve to remain sticky or harden a bit due to demand-supply dynamics in the new year. We see value in 5 to 10 year segment of the yield curve. We also expect 364-day T-bill yield to ease from its current level of about 7 quarters as market unwinds further rate hikes. We expect the benchmark 10-year sovereign yield to trade between 7 quarter to 7.5% in the medium term. It's time for investors to start increasing their fixed income allocation in a gradual manner. Policy rates will peak in the second quarter of 23 and will remain there till the end of 23 before easing in 24. This should lead to a gradual fall in benchmark sovereign bond yields. On the other hand, fresh supply of government bonds will need to be absorbed and may keep the long end of the yield curve sticky. We believe that 5 to 10 year part of the yield curve offers great value to investors. Hold to maturity investors should consider investing in target maturity bond ETFs and index funds maturing between 2028 and 2033 in 2 to 3 tranches to benefit from current levels and for superior tax adjusted returns. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.